Thank you, Elizabeth. Thank you to the organizers for inviting us to present this paper. 14 minutes, Elizabeth?
Yes.
Yeah.
Yep.
So this is joint work with Dimuthu Ratnadivakara, who is at the Federal Reserve Bank of Richmond, and Phil Strawn at Boston College. Just want to emphasize that these are our views and not those of the Federal Reserve or the Federal Reserve System. Okay, we have a very simple question in mind, which is just to try and understand what's driving the branch openings and closings that we are seeing. And we think it's important to understand, answers to this question is important to understand the ongoing industry restructuring that we're seeing. And let me show you a little bit about what we have in mind here. We are witnessing massive and rapid debranching in the United States. So right around, let me see if this works correctly. Okay, there. So the number of banks are in blue and the number of branches are in orange. So right around, I guess if we can see it, I have to go here, sorry. So let me put it this, yeah. Oops. Okay. Sorry, I'm just getting used to this little thing here. Okay, this is the part I want to sort of point out. So right after the global financial crisis, you are seeing a dramatic decline in the number of branches in the United States, okay? And if you sort of parse through this a little bit more, you'll see that the number of branches that are being opened are far fewer than the number of closings. As a matter of fact, you're seeing 3 times the number of closings. So during the COVID period, we closed more than 5,000 odd banks, right? And we're closing about somewhere in the order of about 3,000 odd banks every year. Branches, I'm sorry. And this is occurring across bank size, okay? It's occurring across large banks and small banks. The pace is a little more rapid with the large banks, but it's happening nevertheless with small banks too. Okay? So what we argue is that technology is the force that's driving this debranching that we're seeing, which is that the customer adoption of technology, primarily internet and mobile banking, is what's driving this transition away from branches. So what we argue is that financially sophisticated customers are just generally interest rate sensitive. And if you have a depositor base that's interest rate sensitive, it makes it costly to retain deposits, which then lowers the profits that you can earn from the stock of deposits you have at the branch, i.e. you have a lower deposit franchise value. We also argue that the tech-savvy customers are placing lower value on branch proximity. So the amenity value of a branch is low to them too. So what we show is that banks close branches that have costly deposits, i.e. the branch has low deposit franchise value. Simple way to think about it is that it has a low, where the stock of deposits are low and the depositors are rate sensitive, those are the branches that are being closed. And they're closing branches where customers can increasingly be served digitally, right? Surprisingly, we find that the closure decisions don't have a lot to do with the credit side of the business. Conversely, banks open branches in deposit-rich markets, but also where depositors are rate sensitive, right? The idea here is that rate-sensitive markets are easier to enter and attract customers by offering higher rates. So that's sort of the basic finding here. In terms of why this is an important question, I think it's important to try and ask ourselves why were branches so important from 1980 to 2008. And, This was a period when, where the branch was located, it affected the competition in the local market, branch presence affected what kind of information, how you got to know your customers. I mean, if you had a wide branching network, you could move capital across branches and serve loan demand in, other areas of your geographic footprint. And of course, it had some effects on monetary policy transmission too, right? I mean, so over this period, when we loosen regulatory constraints on branching, I mean, what did we see? We saw, massive amounts of mergers and acquisitions. We saw consolidation in the industry. The number of banks came down. Branches kept going up. But then now, post the global financial crisis, we're actually seeing branches declining. So we think that this technology that's driving this ongoing industry restructuring is going to lead to branchless competition. So it's not that competition is going to go away, it's just that it's branchless. There's going to be more contestability in the markets, potentially more and cheaper credit, higher capital mobility, and perhaps a different way of thinking about relationships, as opposed to soft relationships. Maybe the way to think about relationships now is via data and tech substitute. So soft information becoming harder, becoming more measurable. So the nature of relationships are changing. So essentially the way we go about doing this is simply to show you that there is tremendous variation in the depositor bases that banks serve. So customer demographics vary quite a bit, okay? And these customer demographics are related to the technology usage of banks, related to technology usage by customers, and they vary across banks, okay? I'm just showing you, just the basic stuff on age. I mean, if you just look between large and small banks, you see considerable variation in age, you see considerable variation in education. You also see variations in family income. You see variations in their participation in financial markets. And you also see the deposit beta, which is our measure of how sensitive the bank's interest rate is, or the branch's interest rate is relative to market rates, tends to be higher also. I mean, there's considerable variation. Okay. So conceptually, what we're going to do is we're going to say, look, if there's considerable variation in these demographics, and these demographics are related to how individuals use technology, then these local demographics should influence changes in branch level interest rate sensitivity, which is our deposit beta. And these demographics should also influence how customers use branches, which is usage. And then once we can sort of translate these demographics into these measures of branch, connect them to interest rate sensitivity or the deposit beta and usage, we can then ask, how does this high or low deposit beta influence branch closures? Or how does this beta and usage influence openings? And that's essentially what we try and do in this paper. So we collect data from a variety of sources, a lot of this is pretty standard. I think the only other thing that I might want to point out here is that we do have some, to get at usage, we use some cell phone geolocation data, but outside of that, a lot of it is fairly standard. So what we're going to do is to build a branch level measure of the interest rate sensitivity, which we can't directly observe. We're going to take the demographic drivers of bank level interest rate sensitivity, which we can observe because we know the interest expenses on deposits that banks pay at the bank level from the call report. And we're going to estimate how the demographic drivers, or how variations in the demographics of the customer, or of the customers that the bank serves, influences this beta. And we do this over 3 rate hiking cycles. And likewise, we're going to estimate that model for how, what the usage is for the bank, right? And once we know that, we're going to take how the coefficients on the demographics, in other words, how the demographics, the influence that we can measure, and then say, look, if your branch had this particular demographic, what would its interest rate sensitivity be? And so that's what we're doing when we impute branch level beta and usage, okay? Once we get our branch level beta and usage coefficients, we're going to estimate branch level closures and openings, right? So let me run you real quick and show you that bank level interest rate sensitivities vary quite a bit across the cycles, interest rate hiking cycles that we've had. And the demographics drive this variation pretty consistently across the cycles. Essentially, one way to simply think of it is that if you have a more educated customer base, they also tend to be more interest rate sensitive. That's the first line. Okay? So if you take all of those coefficients and then put in the branch level demographics, here's what you see in terms of the branch level betas. And you see that they vary quite a bit too. And they are different between large and small banks. And they're highly correlated across the different cycles. So in other words, what we're picking up is not something that is not persistent. So if you look, the demographics also drive how individuals use branches. So if you look at the drop in visits, you're seeing that more sophisticated, more educated, younger individuals do not use branches as much. So since I just have a minute, let me quickly wrap up and show you that if you look at, just visually, if you look at the percentage of branches closed and look at the interest rate sensitivity, and we do this by deciles across cycles, you generally see that areas where there are high interest, or customers who are highly interest rate sensitive, are the ones where branches are being closed. And this sort of holds through in more sophisticated models. You don't see any influence on, or we don't see very much from the credit side of the business. So in other words, it's not because of declining loan volumes that banks are closing branches. Okay? I'm going to sort of skip through this and so show you that we find similar things with branch opening. So they're opening branches in areas where the interest rate sensitivity is high and where the markets are deposit rich. Okay? So, in summary, I think the results that we find argue that technology is a primary driver of bank restructuring today. So the key takeaways would be that the deposit rate sensitivity of the customers that you serve is a key driver for branch openings and closings. And we find, the variation in these customer types generates fairly large effects. Surprisingly, local lending, it doesn't drive, or we don't find that it drives the branching decision or branch closures or openings. And last point is that, if you have a customer base that is rate insensitive, it's a great barrier to entry. So that's probably a strong competitive element. Thank you. I've taken in 1 extra minute, so I'll repay it back in some other way. Thank you.